Well, we are in the early stages of what is probably going to be a 2-year recession. So that's where I think we are right now. And the beauty about this call is that it is separates itself from the consensus view that we're going to experience a soft landing, um, or a short and shallow recession. It could be shallow. It's not going to be short. That's where we are.
Okay, we've talked about growth is imploding. We've talked about the likelihood of inflation imploding. We've talked about a troublesome equity market. So that leaves the standout trade, which is bonds.
Yeah.
And people, when I mention this, a lot of people who are not used to bonds, I mean, you and I have been around a while and we know how bonds work, are like, are you crazy buying bonds with 9% inflation? I said, that's exactly the time to buy bonds. Talk you through it. You're also bullish bonds, I take it.
Very much. The inflation rate is a lagging indicator, so I don't really formulate forecasts based on the inflation rate. Do I wish that I would have known we're going to go from 2 or basically 0 to 9%? I wish I was that good. I would have known that was going to happen. I don't know if we call that a 3 standard deviation event. Oil, the front month contract for oil in the spring of 2020 is negative, and then we go to 120. Well,
one point about that. If you'd have known it was going to 9%, we would have said, okay, where are bond yields? We'd have probably said 6, and they went to 3.5. That's got to tell people something, right? There is a structural issue here, much larger than people expect, because every bond bear basically got this wrong. A few people nailed the early move,
fair.
and then
It's a fair point. It's a fair, and look, we got stopped out at 3.5. The peak in the 10-year note was in April 2010 in the last cycle, and we peaked at 4.01. We were there for one day in early April of 2010. Most people don't know that, and it's interesting we got stopped out at 3.5 this time around, because the pattern of hitting lower highs and lower lows is still intact, which is why the secular bull market is intact until otherwise notified. It's not about the size of Bill Gross's pencil and ruler. Okay, the sequence pattern of lower highs and lower lows and yield remains intact. I think that the way you put it, I think, is very, very accurate, very elegant way of putting it. And you're right that we got stopped out. Look, and I think as the bond market is actually quite sophisticated, it realized that, yes, we had a series of supply shocks that are not permanent. And I guess that's what transitory means. It's not permanent. Look, we have the first shooting war in 80 years in Europe. We've had these recurring supply shocks. Complicating it was really quite unnecessary fiscal stimulus for the most part, stimulus checks that got spent right away, exacerbated for a period of a year. It's funny that Jay Powell says, yeah, we've had this inflation now and it's lasted about a year. It's lasted a year. He makes it sound like a year is a long time. I'm there thinking, because I fancy myself as an economic historian, a year in the overall annals of economic financial history, I don't know. I think that might well be transitory. Look, the last time, sample size of 1, that we had a war and a health crisis that went global was back, say, from 1916 and 1920. We back then the war started first, then the Spanish flu. We had 4 years where inflation averaged 15% per year. Now, we didn't have like social media back then, but we had inflation that wasn't 9% for a year. We had 15% over a 4-year period because we had a series of supply shocks. Wars historically tend to be inflationary, and we had a global supply shock on top of that from what happened with the Spanish flu. Once those pressures subsided, and they didn't last indefinitely, okay, there are no new eras. Excesses are never permanent. Once those pressures subsided, we went through 10 years of deflation from 1920 to 1929. And then, of course, we've got the mother of all deflation starting in October 1929. I can't remember the exact year that F. Scott Fitzgerald wrote The Great Gatsby. I think it was 1926. nothing in there on the great inflation. It was only 5-6 years earlier, right? But memories faded. And so I would say that this inflation that we had was transitory. If you're willing to be charitable on how you want to define it. And I think that we are going back into a deflationary period. I think you're 100% right. And I think that the Fed is going to exacerbate that. And remember that, and people got to remember that the lags between what the Fed does in time A and the peak impact on the economy in time Z, the lags are long, variable, and in this particular situation, very insidious. And that's what I mean, is that the recession's already started. I'm wrapping my head around this. The recession's already started. The Fed's still tightening policy. And the peak impact is not going to be until the mid part of next year. So I'm just going to say we are locked into right now. There's no turning back. We are locked into a 6-quarter recession, and it might even be longer than that. That's where I come down. And so I'll tell you this much, even in the 1970s, we had a recession in 1970, 73, 75, 1980. In recessions, guess what? Even in the stagflation era of the 70s, in recessions, demand gets so weak that inflation melts. The question will be, and the question in the 70s was that when the recession ended, inflation went right back up again. Well, as you said, what was technology back in the 70s? What was that? Like an IBM mainframe and a transistor radio from Panasonic? I mean, where productivity was non-existent. And you had a different labor market, a different level. People talk about, it's funny that you mentioned globalization. You didn't talk about the return of labor power. The return of labor power, please, because these young people are job hopping in the restaurant and accommodation sector. You know that despite all the hype and rhetoric about, Amazon workers here, they're certified now, union and Starbucks over here. That, what is it? It's over 300 million workforce. And you read the headlines of the Wall Street Journal. Wow, we got the return of labor power. That's not happening. It's happening in a few sectors. It's not happening. In fact, the share of the private sector workforce that's unionized last year went to a new post-World War II low. So there you go. In the 1970s, it was inflation was almost institutionalized because the economy was unionized and everybody had cost of living allowances.
And also, Dave, as you know, the labor force participation rate is super low because of demographics. So if the group of people in a job gets a 5% wage increase, half of the labor force is out of the job. So therefore, you have to half the total aggregate demand of the wage increase, which is 2.5% and not 5%.
Raoul, the proof of the pudding is in the eating. I mean, the participation rate, the participation rate in the United States, it peaked 20 years ago.
Yeah.
Before COVID and all these supply shocks, inflation was like 2%. Donald Trump could actually cut interest or give us $1 trillion tax cut, and the Fed could continue re-embark on QE in 2019 with 3.5% unemployment rate at the lows, and inflation was 2%. And so, yeah, you're 100% correct on that. But it's like I said before, aging population. It's all about people talked about the great retirement. Yeah, okay, so there's the great retirement as long as that lasted. Now people who've seen their 401ks depleted, they'll come back into the labor market. But be that as it may, the participation rate's been going down for over 20 years, and there was no perceptible inflationary impact whatsoever.
And don't forget, when they come back into the labor force, they're competing with their kids and they're doing part-time work, and they'll do it cheaply because they're only topping up income, which is a natural lower of aggregate wages because, the 70-year-old's coming in and he's doing Uber driving and all he or she needs to do is do it for, 20 hours a week to top up their pension. And so that takes away from the net employment of the 32-year-old who's their kid. People don't look at this stuff. They just look at headline numbers and never think through what's actually happening.
Well, there's something else that is going to feed into this because we're talking about the labor market. And I find it very fascinating, for example, that we get the GDP numbers for the second quarter. Private sector GDP was negative 0.7 annualized. But we know that labor input, aggregate hours worked, was up 2.7%. So what falls out of that is negative 3.4% on productivity quarter on quarter. This will be the third decline in productivity in the past 4 quarters. And it would mean the productivity in the world's most dynamic economy is negative 2%. When people say to me, so what do you make of today's GDP number? I said, I'll tell you what I make of it. It means productivity contracted again. You can count on your hands the number of times in the past 60 years that productivity was negative 2.0 year over year. And each time we were in a recession. The question becomes, how did the corporate sector respond to that? Because you see what happened here is, and this comes down actually to the Fed. You know, it's funny, Raoul, that everybody criticizes the Fed for missing the boat on inflation. But everybody seems to be giving the Fed a pass on missing the boat on the real economy, because we went into this year, the Fed was, in its projections, was saying we're going to have real GDP growth of 4%. At the June meeting, when they produced their last set of forecasts, it was 1.7 for this year. I'm telling you right now, it's going to be 0. Maybe there's an outside chance it'll be fractionally negative, but you can see that if you're a business executive and you're following the Fed, they have 300 PhD economists on staff. You went into this year with the Fed telling you +4 on real GDP. You had to be thinking, I have to pre-order, I have to build my inventory, I got to hire more. But look what happened. Look what we can see in the retail and wholesale sectors in particular, massive excessive over stockpiling. We have an inventory problem. But you see, not just an inventory problem, they hired too many workers. I mean, can you imagine the context of the first half of this year, the economy actually contracted? And yet, over the past 12 months, the average non-farm payroll number was plus 520,000. We went into this year over stockpiled by all the pre-ordering. Now that's got to be liquidated, 100% right. But what about employment? Because I've got to tell you that if we're going back to a situation where the corporate sector is going to have to right-size their productivity, or they're going to lose it on margins big time. So unless we get a revival in output, which seems next to impossible, because we know that the Conference Board's leading economic indicator is down 4 months in a row. And so we have more economic pain ahead. And so there's a misalignment between company order books, production schedules, and staffing. So what's going to happen when you do the arithmetic on what it will mean to right-size productivity? And you're already starting to see it happen, but not in bodies, but hours worked are starting to come down. And that's a great leading indicator. Hours, you're talking about, Raoul, you're talking about in the next year, 2 million jobs are going to be lost.
I mean, Amazon made this clear, right? Amazon are about as good a company on earth as managing inventory of people, products, and everything else. And they came out in Q1 and said, we've wildly overordered, overstaffed. And that was the signal to me. It's like, oh my God, if Amazon, and they were the first to say it, they're like,
endemic.
It's endemic. It's everywhere.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.